Wednesday, February 12, 2026. The Bureau of Labor Statistics releases January employment numbers at 8:30 a.m. Eastern. 130,000 non-farm payrolls added. Unemployment rate falls to 4.3%. Wage growth moderates slightly. Within 90 minutes, silver is down 11%. By the close, silver settles at $75.78 per ounce. Gold breaks below the psychologically critical $5,000 level, closing at 4,166. The financial media has its headline: Strong economy crushes safe haven demand. Higher for longer interest rates return. Non-yielding assets face mass exodus. Clean, simple, explainable, and almost entirely misleading. Friday, February 14, 2026. The Bureau of Labor Statistics releases January CPI data at 8:30 a.m. Eastern. Headline inflation comes in at 2.4% year over year, monthly increase of 0.2%, below the expectations of 0.3% that most Wall Street economists had penciled in. Core CPI, which strips out food and energy, comes in at 2.5% year over year, the lowest reading since April 2021. Energy fell 1.5%. Vehicle prices were muted. Silver bounces 2.5% almost immediately. Gold makes a record weekly close in London. The 10-year Treasury yield drops to 4.07%, its lowest level since early December. Market participants immediately increase bets on a rate cut in the second quarter of 2026. And almost every financial outlet that spent 48 hours screaming about the death of the silver rally moves on without a word about the recovery. That asymmetry is the story. The crash gets wall-to-wall coverage. The recovery gets silence, and that silence is not accidental. Let me break down the jobs report that allegedly destroyed silver in 90 minutes, because the headline number is not the jobs report. It is a press release for the jobs report. The actual data is in the composition. 130,000 total jobs added. That sounds solid, until you look at where those jobs came from. 89,000 of those jobs were in healthcare and social assistance, hospitals, nursing homes, home health aides, assisted living facilities. The vast majority of this category is funded through Medicare and Medicaid, which means it is government spending creating those positions, not private sector demand for labor. Another 23,000 jobs came from leisure and hospitality, restaurants, hotels, bars, low-wage, high-turnover employment that expands when people have credit card debt to spend and contracts the moment that credit dries up. Add those two categories together, and you have 112,000 out of 130,000 jobs. That means the entire rest of the economy, manufacturing, construction, retail, professional services, technology, energy, transportation, all of it combined, produced 18,000 jobs. Manufacturing added 4,000, a rounding error in a $27 trillion economy. Construction lost 7,000 jobs. That is a negative print in a sector that is supposed to benefit from infrastructure investment and housing demand. Retail lost 11,000 jobs, not a sign of consumer strength. Professional and business services added 12,000, but that category is heavily weighted toward temp agency placements. That is not the fingerprint of a robust, broad-based labor market. That is the fingerprint of an economy where the only job growth is in government-adjacent healthcare spending and low-wage service work. But here is the detail that should have stopped every algorithm in its tracks and did not. There are two separate surveys the BLS uses to calculate employment data. The Establishment Survey, which calls businesses and asks how many people they employed, and the Household Survey, which calls individual Americans and asks whether they have a job. The Establishment Survey said plus 130,000 in January, the headline number. The one that every trading algorithm scanned at 8:30 a.m. and responded to within milliseconds. The Household Survey said negative 31,000. 161,000 job discrepancy between the two measures of the same month's employment. The Household Survey is actually considered more accurate for capturing gig workers, self-employed individuals, and people working multiple part-time jobs rather than one full-time position. It shows contraction, not growth. The headline said strong. The underlying data said stagnating. The algorithms read the headline. They did not read the underlying data. And silver dropped 11% in response to a jobs number that, when examined properly, does not show what the headline claims it shows. Now let me give you the macro context that makes that 11% drop even less defensible. The United States federal government is currently carrying $36.2 trillion in debt. The annual deficit is running at approximately $2.1 trillion. Monthly interest payments on that debt are approximately $175 billion. For context, the entire U.S. defense budget is roughly $900 billion annually. The country is spending nearly as much servicing existing debt every 6 months as it spends defending itself for an entire year. 1 month of employment data, regardless of composition, does not change those numbers, not even slightly. The structural forces that drove silver from $24 to $84 are not sensitive to whether January produced 130,000 government-adjacent jobs or 70,000. The math of the U.S. fiscal situation does not care about the non-farm payroll headline. It only cares about whether the deficit is shrinking or growing, and it is growing. Here is what makes the two-day sequence even more revealing. The jobs report drops Wednesday morning. Silver falls 11%. Financial markets are pricing in a 92% probability that the Fed holds rates steady at its next meeting. The narrative is hawkish Fed, strong dollar, no rate cuts, bad for silver. Then Friday morning CPI drops at 2.4%, below expectations. The 10-year yield immediately falls to 4.07%. Market participants start pricing in a rate cut in the second quarter. The narrative flips completely in 48 hours. And silver bounces 2.5% almost on cue. Think about what actually changed in those 48 hours. The structural deficit did not change. Central bank gold buying did not reverse. Global de-dollarization trends did not reverse. COMEX registered silver inventories did not suddenly increase. Physical demand did not collapse. The Silver Institute's confirmed 6th consecutive year of structural deficit did not disappear. India did not cancel its projected 220 million ounce silver imports. The only thing that changed was one inflation data point printing slightly below Wall Street's guess. And that was enough to bounce silver 2.5% after an 11% crash on a jobs report that contained a 161,000 job discrepancy between its two constituent surveys. If silver's price is this sensitive to the gap between 2.4% and 2.5% on a CPI print, while the underlying structural fundamentals remain completely unchanged, then what you are watching is not price discovery. What you are watching is a market that has been deliberately disconnected from its fundamentals and made hypersensitive to data points that give institutional players an excuse to move price in whatever direction serves their existing positioning. Let me show you what the physical market was actually doing while paper silver was being demolished. During the sell-off on Wednesday, physical silver dealers across the country reported unchanged or rising premiums. Online dealers are currently charging 15% to 25% premiums on silver coins, even as spot price was sitting at $75. That means the all-in price for a 1-ounce silver eagle during the lowest point of the paper crash was still well above $85. Physical buyers were not panicking. They were not flooding dealers with metal to sell. The premiums, the spread between paper spot price and what you actually pay for real metal, did not compress. They held. In some cases, they widened. That is the single most important data point in this entire story, and it received zero mainstream coverage. If the 11% crash in silver was a legitimate market response to genuine economic news, physical buyers would have responded by backing off. Premiums would have compressed as demand evaporated. Instead, the opposite happened. While paper price crashed, the line between paper price and physical price widened. That is the fingerprint of a paper-driven move that the physical market rejected. Now let me connect this to the broader COMEX picture because the timing of this crash is not coincidental. March open interest in silver futures currently sits between 85,000 and 91,000 contracts depending on which day you check. Each contract represents 5,000 ounces. That means outstanding paper claims for March delivery range from 425 million to 455 million ounces. Registered silver in COMEX vaults, the metal that is actually available and warranted for delivery, is approximately 82 million ounces after a sustained drawdown that has reduced it by roughly 75% since 2020. The ratio of paper claims to deliverable physical metal for March is somewhere between 5-to-1 and 6-to-1. That is not a market operating normally. That is a market operating on the assumption that the overwhelming majority of contract holders will never ask for physical delivery. And first notice day for March contracts is February 27th, 13 days from now. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That was roughly 26% of registered inventory disappearing in a single week. Someone is not rolling contracts forward. Someone is taking metal. And the pattern of open interest is telling the same story. Analysts have noted that open interest in nearer-term contracts is actually rising, while open interest in March is showing signs of rolling backward, which the simplest explanation suggests means longs are positioning to take delivery sooner rather than later. Shorts who were hoping longs would roll indefinitely forward are finding that assumption increasingly dangerous. An 11% crash in paper silver, engineered on a jobs report whose underlying composition did not justify the reaction it produced, arriving exactly 2 weeks before first notice day for a March contract with a 5-to-1 paper to physical ratio, does not feel like coincidence. It feels like the playbook that has been run in this market 3 times in modern history. September 2011, when the CME hiked margin requirements 5 times in 8 days to break a parabolic rally. March 2020, when hedge fund equity margin calls dumped paper silver to $12 while physical dealers had nothing on their shelves. March 2008, when a Fed intervention rumor broke a gold rally cold for 72 hours before the real systemic crisis arrived 6 months later. In each case, the mechanism was different. The outcome was the same. Paper price crashed on a narrative. Physical demand held or intensified, and recovery followed. Let me address the Federal Reserve angle because the jobs report was specifically framed as a Fed story. Strong jobs data means the Fed does not cut rates. Higher rates are bad for non-yielding assets like silver. That is the causation chain the media presented, except that chain is far weaker than it appears. Silver's bull market since 2022 was not primarily driven by low interest rates. When rates were near zero in 2020 and 2021, silver was trading between $15 and $30. When rates rose sharply in 2022 and 2023, silver held and eventually broke higher. The structural drivers of this silver bull market are not interest rate sensitive in the way a bond or a growth stock is interest rate sensitive. They are deficit sensitive. They are de-dollarization sensitive. They are physical scarcity sensitive. None of those sensitivities are addressed by one jobs report showing 130,000 government-adjacent jobs. But algorithms do not read Silver Institute deficit reports in microseconds. They read headlines. And the headline was, "Strong jobs, hawkish Fed, sell silver." So they did. And then the CPI came in at 2.4%, and the same algorithms read that headline, and silver bounced 2.5%, and the cycle repeated itself in reverse. The sophistication of modern market moving is not that the manipulations are subtle. It is that they happen faster than human traders can respond. And the narrative that explains them sounds just plausible enough that most people accept it and move on without checking the composition of the employment data. There is a detail in the CPI report itself that deserves far more attention than it received. The January CPI headline came in at 2.4% year over year. The shelter component, which makes up more than a third of the entire CPI calculation, rose just 0.2% for the month, bringing its annual rate down to 3%. That is a significant deceleration. For years, shelter inflation was the primary reason core CPI stayed elevated, even as goods prices fell. Shelter coming in soft is the single most important disinflationary signal in the data. It suggests that the Fed's restrictive policy has finally worked its way through to housing costs. If shelter continues to decelerate at this pace in February and March, the case for a June rate cut does not just strengthen. It becomes the consensus, and a consensus expectation of a June rate cut is fundamentally bullish for silver over the next 4 months. But here is the contradiction that nobody in mainstream financial media has addressed directly. If the CPI print was genuinely that significant, why did silver only bounce 2.5% after dropping 11%? If the jobs report was strong enough to justify 11% down, a CPI miss should be strong enough to justify at least that much backup. The asymmetry between the magnitude of the crash and the magnitude of the recovery within 48 hours tells you that the crash was amplified beyond what the data warranted, and the recovery is being suppressed below what the data warrants. That is not a naturally occurring market dynamic. That is a market where downside pressure is being applied from institutional sellers with short positions, and recovery is being allowed only far enough to reset for the next entry. The Treasury market confirmed this reading. When the jobs report dropped Wednesday and silver fell 11%, the 10-year Treasury yield moved from 4.23% to 4.26%, 3 basis points. If the jobs report was genuinely signaling a strong economy where the Fed would hold rates significantly higher for longer, bond investors should have sold aggressively. Yields should have moved toward 4.4% or higher. 3 basis points is noise. It is not the bond market confirming the narrative that crushed silver 11%. The bond market looked at the same data and essentially shrugged. The dollar index moved 0.5%. The S&P 500 moved 0.3%. The only market that reacted violently to data that the other markets largely ignored was precious metals. That selective, isolated, outsized reaction to data that did not move comparable markets is the definition of a targeted operation. Now here is the key question. Where does this leave silver going into the most important delivery window in recent COMEX history? Shanghai is closed for Chinese New Year from February 15th through February 23rd. That 8-day window removes the primary Eastern physical buyer from the market. Historically, this creates a period of Western paper dominance where price can be pushed in whatever direction serves institutional positioning before Shanghai reopens and physical demand reasserts itself. The China angle matters because Shanghai had already been trading at a $6 to $10 premium over COMEX prices before the closure, a persistent gap that signals Eastern buyers were willing to pay significantly above the paper price for real metal. When Shanghai reopens on February 24th, watch whether that premium reasserts immediately. If it does, it means the paper crash accomplished nothing in terms of genuine supply and demand balance. It only temporarily widened the gap between paper fiction and physical reality. February 27th is first notice day for March contracts. The 13 days between now and that date are the most consequential in this story. Either a significant portion of the 85,000 to 91,000 open interest contracts roll to May, cash settle, or stand for physical delivery. If even 20% stand for delivery, that is approximately 17,000 to 18,000 contracts, or 85 million to 90 million ounces of silver demanded against 82 million registered ounces available. The exchange does not have enough metal to fill that order. It will either have to convert eligible silver to registered, source metal from outside the vaults at whatever price it takes to get it, or invoke cash settlement. Cash settlement at a manipulated paper price, while physical premiums are 15% to 25% above spot, would be the clearest signal yet that the paper and physical markets have permanently decoupled. The jobs report on Wednesday was presented as the reason silver died. It was not. The jobs report was a data point with a misleading headline attached to a composition that told a much weaker story. The 161,000 discrepancy between the establishment survey and the household survey was not mentioned on a single mainstream financial broadcast that I could find. The fact that 86% of the jobs added came from healthcare and hospitality was treated as irrelevant to the headline. The fact that construction and retail lost jobs in January was buried in paragraphs that most casual readers never reached. The headline did its job. Algorithms responded, paper silver crashed 11% in 90 minutes. Institutional players covered shorts and accumulated physical at an 11% discount from 24 hours prior. And then the CPI dropped, soft and silver bounced 2.5%, and the cycle prepared to run again. What you are watching in real time is the mechanical operation of a market where the paper price is a tool, not a signal. The signal is in the physical market, where premiums held through the crash. The signal is in the COMEX vault data, where registered inventory has fallen 75% in 5 years. The signal is in the delivery patterns, where January alone saw 33.45 million ounces pulled from registered inventory in 7 days. The signal is in the open interest patterns, where longs are rolling backward toward nearer delivery months instead of forward away from delivery. Every signal in the physical market says the same thing. Every signal in the paper market says the opposite. One of them is processing real information about supply and demand for actual metal. The other is processing 8:30 a.m. headlines through algorithms that execute before any human being can think critically about composition data. The jobs report that supposedly destroyed silver added 89,000 healthcare aid jobs funded by Medicare. The 11% crash produced by that headline lasted 48 hours before a CPI print reversed half of it. The physical market never agreed with the paper price at any point during either move. March 1st notice day is 13 days away. Shanghai reopens in 9 days. The COMEX paper to physical ratio for March sits between 5 to 1 and 6 to 1 against 82 million registered ounces. The math of the structural situation has not changed because of 1 month of employment data. The structural forces driving this market have been building for years, and they do not reset on a Wednesday morning because an establishment survey counted 89,000 hospital workers. The paper price said sell, the physical market said hold. The CPI said the paper price was wrong within 48 hours. When the next data point arrives that gives algorithms an excuse to push higher, watch how quickly the recovery accelerates past what a 2.5% bounce would suggest. Because the gap between where paper prices are and where physical demand says they should be is not getting smaller. It is getting larger with every manufactured move in either direction. The jobs report that wasn't destroyed silver for less than 2 trading sessions. The physical market that never believed the crash is still there, still paying 15% to 25% premiums over a spot price that moved 11% in 90 minutes and then bounced back before the week was out. That is not a market that has repriced silver lower because fundamentals changed. That is a market that temporarily moved a number on a screen while the actual metal in the actual vaults continued doing exactly what it has been doing for years, moving from paper claims into physical hands 1 delivery at a time, with first notice day for the most consequential delivery month in recent COMEX history now 13 days away. The paper price is the noise. The physical market is the signal. The noise ran 11% in one direction and is already reversing. The signal has not changed in years.